last few years, growth investing has dominated the South African investment landscape, resulting in the near abandonment of the value investment style by both investors and almost all investment managers alike. Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers, joins us in studio for a look at how the investment cycle has turned and the opportunities that the market's aversion to value is creating. Well, you've stood hard and fast in value territory. It has been a tough environment to hold to your guns, effectively. But it's all working out.
Slowly. Yeah, the last 3 years, I think, since global financial crisis in 2008, it's just been a growth cycle. We've obviously spent a lot of time trying to understand what's happening in the markets, what investment philosophy is rewarding. And yeah, obviously growth has just been the name of the game over the last 3 years. Thankfully, value investing hasn't been rewarding, otherwise we would have to question our stock picks. But yeah, you can look at it, price earnings, dividend yield, price to book, price to sales, whatever multiple you look at, that's been underperforming over the past 3 years. And what we're seeing now is that it's actually slowly starting to turn. I wouldn't say
What's the kicker here? Why are things turning?
I mean, we know from history that growth and value, they work in cycles, and generally you're looking at about a 3-year cycle, and we've been through a 3-year cycle now with growth investing. What is the kicker? I think at the moment everyone's very much in love with the Africa story, the Asia story. They're going after these growthy companies that are exposed to these sorts of areas. Now, if you look at retailers, they're sitting on PEs of 25 times. This is where construction companies were 5 years ago. Group 5, for example, was on a PE of about 30 times. It's grown its earnings about 30% over the past 5 years. Yet today, it sits on a PE of 8 times. So I think we've seen this sort of cycle play out again. And slowly but surely, I wouldn't say that value has returned, but what you've seen is that there's performance coming across the spectrum of the market. So it's not just your growth shares, but your value shares are also beginning to stand up.
Okay, Andrew, over what period have you seen growth starting to outperform value when you say the cycle has turned?
Growth started to outperform probably in the last quarter of 2011. Construction is a good example. It was the worst performing sector in the market last year. If you look this year to the end of April, it was the top performing sector. So we're starting to see these smaller, more locally focused industrial companies, if I can call them that, stand up. And these are your IT companies, your Hidekos, your Grindrods, your construction companies, for example, where previously what you've seen is your big, large cap, your SABs, your ShopRites, those sorts of companies.
So it was value in the last quarter of 2011.
So value is what you've seen. And I'm not saying that growth has disappeared. These companies are still doing well. We've seen these results coming out today, for example, Richemont's results last week. So it's still, that's what I'm saying. It's not only value that's performing now, but value is starting to perform, which excites us.
Can value hold its own? You referred to a 3-year period. Do you think that's what we're moving into now, that value will continue to perform? I know this is very difficult. And I suppose it's tantamount to forecasting. Maybe I should just stop right here and talk about the construction industry.
Look, I wish I could say that's going to be the case. We don't know. Growth could carry on for another 2 years.
Historically, trends dictate that this could be
historically, we're thinking that this is probably the turn in the cycle is what we've seen at the moment.
Yeah, because the one thing that seems to have supported growth companies is the availability of cash to do transactions. I mean, loose cash monetary policies in the US, China, and generally Asia has seemingly supported the higher PEs as people chase growth around the world. Don't you think that's really going to be the tipping point in favor of value when people start pulling that cash back?
Yeah, I think quantitative easing is a big risk, and we identified this as a risk to our business years ago. A lot of free cash floating around, as you say. People spending that money, they're in love with the emerging market theme. They're putting their money into these sorts of companies that have this exposure, and that's what's hurt us one hell of a lot. If quantitative easing, it's still going on to a certain degree. When they do pull that money back, we would expect to see some of that money flow out of the system. Companies with cash, you talk of, that are doing well, they've got the cash to grow. We've seen value companies as well. I mean, these companies are still fantastic they've got strong balance sheets, they're high-quality businesses. They're still holding big cash piles that have seen them through the tough times. So we don't think, this is what we sort of battle to understand, is that these companies aren't poor quality businesses. They don't deserve, Wilson Bailey Homes doesn't deserve to be on a PE of 7 or 8 times. This is a good quality business, strong balance sheet, lots of cash. They can fund growth going forward. There's no concern there, so yeah.
But the big concern has been the margins that construction companies are making on projects they've signed over the last 3 years. I mean, Murray and Roberts at times have signed contracts with 1.5% margins.
I mean,
so there is that risk.
There obviously is that risk, and I mean, your order book. People say, oh well, construction companies' order books have held up well. Yes, they have, but the margins.
At what margin is the big question?
The margins have been squeezed, so they do deserve. I mean, 5 years ago, we didn't think they should be on a P of 25 to 30 times. Likewise, today we don't think they should be on a single-digit PE. Yeah, they should probably trade at a bit of a discount to the market based on these margins that we talk about, but definitely not at single-digit PEs. And it's not just the construction sector. I mean, you can look across the market, and there's, especially now after the recent sell-off in the early parts of this month.
What else is offering value? Before we move on to the Canon Flexible Fund.
There's some very good opportunities out there.
Like?
Well, I'm going to put some names on them. Mete, for example. This is a company that has done extremely well. They produce parts for motor vehicles. They've got their battery center. They're one of 3 companies in the world that have this technology to do this stop-start battery. Now they've grown. Their price has increased about 100% over the past year. A year ago, they're on a PE of 8 times. They remain on a single-digit PE today. It's gone up 100%. We're happy to stay in companies like that.
Let's go into the Canon Flexible Fund and your offering on this front. 2 asset classes, equity, cash. Generally, do you sit with a 25% weighting to equity, 25% weighting to cash? Would that be the strategy?
The strategy, it's rules driven. It's run by what we call the cyclically adjusted P ratio. And what this does is it takes your earnings over 7 years and it inflates them to today's prices and takes the average. So instead of using a 1-year earnings number, which can be affected by the economic cycle, you're looking through the cycle. So you get a better sense of the DNA of what a company or the market can actually do. So we use that tool to gauge the relative attractiveness of the market. As an average, we'll sit at 75-25. 75 equities, 25 cash. We break it up into quintiles. So when that tool gets into quintile, what we would call quintile 1 is your cheapest 20% of the market. When it hits quintile 1, we'll increase our equity exposure to 100%. When it goes down to quintile 5, we'll take it to 50%. So we move in increments between 150 based on what quintile the CAPE ratio or the cyclically adjusted PE ratio sits in. So at the moment, the market sits in quintile 3. We don't think it's that expensive. It's definitely not at the screaming levels it was in 2009, early 2009. So yeah, we at a 75-25.
75-25 split. Ashraf, you wanted to take a point.
One question. Your top 10 holdings there, dominated by resource companies. I didn't see one construction company. So you telling us that resources is where you guys really want to be right now?
Resources have had a strong drive to value over the past few years. They've really underperformed. We are overweight resources. We're not massively overweight. We're overweight a few percent, which historically we don't generally hug the benchmarks that closely. But we are quite close to the benchmark.
Not all. The top 10 are not all resources.
No, not all resources,
you've got your Old
but
Mutual,
dominated by
AECI, Met, Pinnacle Technology, Nedbank, and Steinhoff. I mean, your resources are Anglo American, Sasol, and Old Mutual. They're big players.
Yeah.
Have you seen that?
AECI.
Right, a feeder into the resource company.
Yeah, we would call AECI. I'd agree with you. It's a resource company.
All right. I stand corrected. So four of their top 10 are resources. Is that right?
Yeah. But we do like the resource sector at the moment.
But then I've got to ask you, what are value managers doing in the resource environment? Because you have often said, and when I've spoken value or I've interviewed value managers, it's very difficult to predict the earnings of the resource companies, given that they're dependent on so many external factors, commodity prices, exchange rates, etc., etc.
Yeah, resources they're a nightmare. Everyone knows this for a value manager. What we use, the tool that we place the most emphasis on is this CAPE ratio, which I'll talk about, because you're getting a sense of what the company can do through the cycle. What resources do we like? Diversified industrials at this stage. ARI is another one that we own. We used to own Assol. Assol's only asset is 50%. It owns 50% of Assmang. ARI own the other 50%, and on top of that, they've got a 15% holding in Harmony, plus some platinum exposure. Last week, Assol's share, market cap was larger than ARI's market cap, and stripping out the debt and the cash, the enterprise value of the business wasn't that much bigger than Assol. So you're getting the same asset as you're getting through Assol, but at a huge discount. So these are the sort of things that we're looking at in resources.
Look,
Andrew,
I don't disagree with him.
One more comment.
I don't disagree with him on African Rainbow, because it's certainly now trading on a PE of below 10, with growth prospects of around, or earnings growth of around 30% for this year. So a good business, but still a challenge for them.
I see, and a debate for another day. A debate for another day. We'll get you both back. Andrew Dittberner, Senior Investment Manager at Cannon Asset Managers, thank you very much for your time.